Hello there, this is James and you're watching Tixee Live. And a very good morning to all of you, and all of you a very happy Friday. In today's program, I want to talk about whether or not we're beginning to see the beginning of cracks in the labor market and the beginning of maybe the decline in the markets. But before we get into all of that, don't forget these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence, and of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So, obviously, we all know about the U.S. labor market. We take a very close eye on it because obviously there's a lot of anticipation that the increases of interest rates by the Fed in the United States is going to slowly push the U.S. into a recession. And obviously, the labor market in the U.S. at the moment is very, very strong. And as we saw from yesterday, from the initial claims, 198,000 versus 215,000 expected. So yes, the labor market is still pretty strong. But are we beginning to see a slowdown? You know, are there signs now that labor market is beginning to feel the cracks? Because at the moment, despite the fact they've got interest rates above 3% in the United States, nobody's quite feeling the pain yet. Well, the reason why I say this anyway, the reason why I'm beginning to ask, is this the beginning? Is because Facebook or Meta announces it's freezing hiring, it's reorganizing to save costs and reducing headcount. Now, Meta has never done this since its existence, since 2004. So that's a little bit worrying. Obviously, we've seen the issues with the social media market because of obviously the cost of inflation. Ad revenue is dropping. So this could be a thing. But is this the beginning of something a bit deeper and a bit darker? As well as that, Amazon, another huge company, has announced it's going to close all but one of its customer support call centers. Okay. In fact, what they're going to start to do, they're going to try and encourage some of their employees to work from home. And this is to save money on real estate. Now, this is being blamed, or they're putting this down to the fact that rising inflation and uncertain economic outlook is to blame for this reason. For why? So, again, we just got two very big companies, in the space of 24 hours, announcing cutting back on hiring and actually reducing its headcount, and another one closing all but one of its call centers. It does make you wonder. And don't forget, Apple, 2 days ago, have said that they don't want to increase production of their latest flagship phone, the iPhone 14, because demand is not as big as they anticipated. And as you know, those of you who were kind enough to join me yesterday, they were downgraded yesterday by Bank of America. And this caused, obviously, for their stocks the stock price to fall. They were downgraded from buy signal to neutral, meaning no, not necessarily a good, but a good thing. And like I say, Apple, in many ways, because Apple was under pressure, we had a bad day in the market yesterday. We'll go over a few things in a minute about it. Apple sort of led the way because following Apple yesterday, Alphabet, which is Google, and Microsoft both hit a 52-week low yesterday, driven by Apple's sell-off. So, and as well as that, equity market, S&P fell by 2.1% yesterday. Nasdaq sank by 2.8%, and US 30 dropped by 1.5%. So not a good day at all. Currently, as the indices are, they're slightly up again today, slightly in the green. You've got S&P up 0.84%. US Tech currently trading 0.83% higher, and US 30 currently trading 0.71% higher. So, again, after a big sell-off yesterday, you can expect some sort of dip buying. But anyway, let's have a quick look at the market on the ones we discussed. So this is Apple, and like I say, did not have a good day yesterday. She currently closed around $142.19. And like I said, this spurred on obviously a drop as well in Google as well, Alphabet, and that closed lower. And of course, like I mentioned as well, Microsoft as well came under pressure as well yesterday. So it was not a good day for the market in particular yesterday. So if I look at Microsoft here as well, you see Microsoft as well closed at 237. So not a good day, not a good feeling for the market yesterday. Anyway, moving on. What's the one thing we've been talking about a lot this week? And no doubt we're going to talk about it a lot again in the future. But today, surprisingly, I've got some good news to talk about from the UK. Good news for the UK for a change. And that was UK GDP, which I anticipate, and I think many analysts anticipated to come in low and actually indicate that the UK is slipping into recession. Actually came out better than expected. It actually came out 0.2%, surprisingly at 0.2%, versus negative 0.1% expected. And as we can see with the FTSE, that's actually had a bounce on the back of that. This is quite surprising good data for a change. And we are seeing the sterling on a bit of recovery. Now, we'll talk a little bit more about this in a minute, but let's have a quick look at the sterling now, where it is. Because like I say, it's been in the spotlight so much so much this week, because obviously what's happened from Friday onwards, touching an all-time low. It has since recovered, and now basically we're trading pretty much close to the levels it was trading at. It was trading at before the mini budget was announced. So before that, again, it is benefiting from that better than expected GDP announcement, but there is a little glimmer of hope sleeping in that the government, or the UK government, might alter their course a little bit with their tax cuts. Now, as you can see, it's slightly trading higher, currently trading now at 1.1225, which is great for sterling bulls. In my personal opinion, working out pivot points, the first potential area I can see of interest would be 1.1237. That's using the daily pivot points. So that's something I'll be keeping my eye on at the moment. Obviously, we've got a long way to go to break that downtrend, as we can see with the trend line we've got there. So it's got a fair bit of way to go again to really realistically, break the current trend it's experiencing. It's not just the sterling though as well. The euro's having a better day as well. Testing now or eyeing a key level, in my opinion, of a 0.9870. In many ways, basically, we're having a slightly weaker dollar. I think really the market is slightly negative about that 0.6% GDP reading. This is what's weakened the greenback slightly today, even though it was expected. But like I say, the euro is having a better day today as well. 0.9870 is a key area of interest for me. I'm keeping an eye on. Currently trading at 0.9840. Gold, again, now really testing this key area again of $1,667.85. Currently trading just above it, but it hasn't cleanly broken through it yet. So it's currently trading $1,761.25. If we can get a clean break through that, if we can really maintain this dollar weakness today, then the next area of interest for me after that for gold would be $1,694.30. So that's how the market is trading currently at the moment, currency-wise, in a slightly better mood against the dollar, which after the rot and the carnage it experienced at the beginning of the week, I'm not surprised. But is this going to be a strong road of recovery? Certainly for the sterling. In my personal opinion, for now, I think, like I say, it's going to enjoy a little bit more of a boost. Obviously, that UK GDP helped. This hope of trust, government backing down, I don't think it's going to happen. I think they're going to underline that again at the conference, which might put pressure on it. With this in mind, with its current path, the chances of the Bank of England again intervening and raising interest rates as an emergency, lest we see a big drop-off, I can't see that happening. I can see them now holding out to November, unless the sterling starts to fall under pressure again, which in the future I certainly can see happening. And there's another thing I want to talk about with the sterling, okay, and that's the UK mortgage market. Those of you who've watched me, I take a key interest in the housing market for both the UK, Canada and the United States, because they're both huge markets. An increasing of interest rates is obviously going to put pressure on people with mortgages. I've gone over this a number of times because I think this is a story waiting to happen. I really do. I really think, though we are beginning to see people look at it, it's still not really headline news as much. But I think in the future, this will become a big deal. But as we know, on Monday, after the sterling collapsed, and I just want to illustrate the situation of the market at the moment, because there was a very interesting interview I saw with a new first-time buyer who was trying to get on the property market in the UK. As we know, on Monday, because of the carnage of the sterling, mortgage lenders removed at least or over 300 different types of mortgage products. 300 mortgage products. They retracted them, okay, because they are worried about interest rates rising dramatically. And here's the thing. This first-time buyer, as I mentioned, I saw her interview, and she said her initial offer, which she was about to sign, was for an interest rate of 4.5%. Okay, 4.5%, and she was about to obviously, finalize the contract, but then of course it was revoked because of what happened on Monday. Her revised offer from the bank was an interest rate of 10.3%, which is frighteningly big increase. 4.5 to the new offer of 10.3%. And even then, the bank told her, you better act fast on this because we don't know how higher it might go. So very, very scary stuff. Something else which is scary, which is happening today, is happening actually in 8 minutes' time. This is going to be interesting for the euro, see how the euro reacts. Let's put on my chart just in case, as I'm talking, we see some dramatic movements all of a sudden, in case it comes out while I'm still here. EU CPI today, due in about 7 minutes. Expectation for the CPI is for it to come in at 9.7%. 9.7%. Don't forget, we had a real shocker from Germany yesterday. Their inflation reading was 10.9%. 10.9%. They're part of the 10% club now. Like the UK was, and the UK will be again, I have no doubt. But 9.7 is the expectation. Germany was 10.9. So it'll be interesting to see what the EU CPI comes in at in about 7 minutes. So this could be, it'd be interesting to see how the euro reacts as well, because, we already know that, or basically pricing in, the ECB will be raising, most likely will be raising interest rates next month by 75 basis points. So they're pricing that in. Will a more dramatic reading, will that maybe give the market speculation or hope to speculate that it may be even more aggressive? We'll just have to see. So really, like I say, that's the main event today, is just the EU CPI. So like I say, that comes out now in 6 minutes. So if you have any questions, I might be able to stay online and watch it. The European market, as it stands, FTSE in the green, 1.21%, boosted by that better than expected US GDP. DAX 1.41%, and Eurostock 50 currently trading 1.38%. So a bit of a green across the board at the moment as it stands, which is not surprising, as the stock market did have a pretty bad day yesterday. Don't forget, you can ask me questions anytime you wish, or simply say hello if you like, or show me your opinions. What do you think? Is there a bad moon rising? Am I right to start looking at things like this? I mean, like, the argument could be, okay, it's one company, well, it's two companies, James, who are downsizing, and they had mentioned in the past they were looking at doing this, which they had done. So there's no big surprise. Initial claims yesterday was still very, very good, James. So how can you say, are we beginning to see the cracks? But I'm just, morning. Good morning, my friend. How are you? I'm very good, mate. Great to see you. I'm wondering why we don't see an increase in natural gas prices with all the news surrounding it now. Okay, well, like I say, don't forget, Germany is about to do an emergency energy plan, okay? And the EU are trying to come up with an emergency energy deal to cap prices, because obviously they're facing a real big issue. The fact of the matter is, we had been, the fact that the Russian oil gas was going to stop had already been priced in. So we knew this. So the fact that Nord Stream, there was a new crack in Nord Stream 1, that's happened this week. It's already been priced in. They just assumed they're not going to get any gas from Russia this winter. So this is why we're not seeing any dramatic movements in natural gas prices currently at the moment. European natural gas, however, don't forget this is US gas, which we trade. European gas is still pretty volatile, though. So though it's not as violent as it has been in the past, because obviously we already know these concerns. It's being kept at the moment. It depends on how good this energy deal is. You see how much Germany can do with this new energy package. I think they're going to borrow something like 200 billion, something like that. And we see how the EU energy deal they're trying to put together, how they can cap prices, see how that works. But that's the reason. Oh, mate, great. No, it's always a pleasure. It's really good to see you, buddy. Really good to see you. It really is. What do you think about the housing market situation? I know I talk about it a lot. I do. I really do, because I think it's... Hey, I used to be, years and years ago, I used to be a mortgage broker. But that's also why I know that industry quite well. But I just have a feeling it's a big story waiting to happen. What do you think? Do you think I might be onto something there? I'm not the only one. There is talk. Other people are talking about the US housing market, because I think US interest rates are closing in around nearly 7% now. And I think the overall percentage of household income to pay the capital and the interest is about 36% is needed of overall household income just to cover the mortgage, which is, again, that's a scary figure as well. So, yeah. Is there any other questions at all? Bless you. If I listen to your opinion, reference housing, then speak my own here. Mate, every opinion is valid. Every opinion is valid. It really is, my friend. It really is. Every opinion. Because if no one's always right, we can all speculate and have a look at it. So, it's an open forum, but you're a star, my friend. Thank you. You are. Is there any other questions at all? We've got 2 minutes. That's absolutely true. It really is. It really is. I mean, this is the problem. And like you say, when they're raising interest rates, this is the other thing, which, you put pressure on, like I say, the people paying their mortgages. But how quickly can it bring down inflation? I mean, if the UK's should be aggressive. Bank of England needs to be aggressive for its next decision after, obviously, what's happened this week. And people are now talking about BOE doing 150. But they said even if they start raising interest rates, their inflation is still going to be high till maybe 2025, they reckon, till they get down to their target. So to get down to the target of 2% by 2025, that's what the Bank of England are projecting in the current situation. So it's still going to be really expensive for food and energy. So inflation is not coming down on that. And mortgages are going up. So it's going to be a really tough, really tough time for small incomes or middle income families. A really, really tough time. But you're absolutely right. It really is. It really is. And like I said, that poor first-time homeowner, I couldn't believe that when I saw her. Interest rate of 4.5, but now she's getting offered 10.3. And she had to move fast on that because that might go up even higher. That's petrifying. It really is. Okie doke. Actually, how many seconds? We've got 3 seconds. We might as well have to do a bit of a watch along and see what the CPI is as we're still here. We might as well do that, haven't we? Have a quick look. I'll pull the euro up as well. I've already got the euro up on my screen. Okay, not much of the movement. So they should be coming out any minute now. Let's have a quick look. See what it is. See what it's coming at. So not an awful lot of activity on it. Let's have a look. Bear with me. Okay. Ooh, this is interesting. I can't believe the euro's not reacting to this. Let's put it on 30 minutes. This is interesting. Have a guess what the CPI is coming at. Expectation was 9.7. The actual CPI number, 10%. 10%. Like I say, obviously the market's not really looking into this or trying to digest this. 10%. is their CPI reading. That's frightening, that is. 10%. So, they're following Germany's footsteps, so to speak. 10.9. Germany's 10.9, EU 10%. 9.7 was anticipated. 10%. That is a shocker. That is a shocker. Let's see what the euro sterling reacted. No, not really. Okay, well, like I say, they obviously know the Bank of England is going to do 75. So, but yeah, well, maybe they just need a bit of time to digest this. But that is a frightening reading. 10%. Wow. Is there any other questions at all? I thought we'd stay on just to sort of cover that as it breaks, as we're still here. Okay, if there is no other questions, don't forget, you can always put the questions in the comments section, either on Facebook or YouTube. I will see them, and I will reply to them next time I go live on air, which of course will be today at 2 p.m. UTC to cover the US session. So please come along and join me for that. If there is no other questions, big shout out to Johan, my friend. It's great to see you again. Thank you so much, and thank you for your interaction and your questions. It's really great to see you, and thank you. And thank you every single one of you that come along to watch me today. But anyway, as I always say, if you're watching me on Facebook and you enjoyed this little video, by all means, give us a follow. If you're watching me on YouTube and you enjoyed this little video, subscribe if you like. Hit the notification button so you know next time when I'm going live. And like I say, if you enjoyed this video and found it useful and interesting, give me one of those. It's nice to know that you like what I do. I see I've got a couple of likes and a love heart already, which is really nice. Really nice. I really appreciate it. Anyway, till next time, don't forget, these little videos are for educational purposes only. And in no way whatsoever should be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.